Imagine a country, despite having a national debt equivalent to 260% of its economy, it is still standing. For comparison, Greece collapsed at 200%, Argentina went bankrupt at 90%. Turkey experienced a crisis at around 40%, but this country is still not collapsing. On the contrary, it is the world's third largest economy. It has one of the lowest unemployment rates. Interest rates are below zero. Investors still trust this country. How is this possible? This is the story of Japan, the world's most indebted country that has not gone bankrupt. So what is the secret, and how long can this model last? Let's talk about it. By the end of 2024, Japan's total public debt will be $10.5 trillion. That's 264% of its economy. What does this mean? Japan owes 2.6 times what it produces in a year. Let's compare. The US debt ratio is 123%. Italy is 144%. Greece collapsed at 146% in 2010. It was at the IMF's doorstep. The streets were in turmoil. Unemployment rose to 27%. But Japan has been in this debt spiral for 30 years, and every year they say Japan will collapse, but it doesn't. The 10-year bond yield is around 0.5%. Inflation is under control. Unemployment is at 2.5%. The system is still standing. This is a world where financial rules don't apply. Either Japan is rewriting economic science, or it's sitting on a time bomb. Which is it? Let's solve this impossible equilibrium. Japan wasn't always in debt. In the 1980s, Japan had an economy that was the envy of the world. Sony, Toyota, Nintendo. Made in Japan was a symbol of quality. Between 1985 and 1989, Japan's bubble was inflating. Real estate prices were skyrocketing. The land value of Tokyo exceeded the total value of the entire United States as the stock market index tripled in 5 years. Everyone was getting rich. But in 1989, the bubble burst. Real estate prices fell by 80%. The stock market shrank by 60%. Banks were on the verge of collapse. This marked the beginning of the lost 30 years. The Japanese government acted in panic. It began spending money to revive the economy, infrastructure projects, incentive, bailout packages. In 1990, public debt was 60% of GDP. In 2000, it was 140%. In 2010, it was 200%. In 2024, it will be 264%. In 30 years, debt quadrupled, but Japan is still standing. Japan had 3 golden rules. Rule 1, borrow from your own citizens. This is Japan's biggest secret. 90% of the debt is not to foreign investors, but to its own Japanese citizens and institutions. The bond buyers are actually Japanese banks, pension funds, insurance companies, and the central bank. They are all Japanese. Remember Greece, most of whose debt was held by German and French banks. When the crisis hit, foreigners immediately sold their bonds. Interest rates skyrocketed, and Greece eventually collapsed. That's a topic for another video. Returning to Japan, the situation here is different. Japanese investors aren't selling bonds because they have nowhere else to put their money. Japanese banks are accumulating too much cash. Where can they invest it? Overseas is risk. The stock market is uncertain. The only safe haven, government bonds. The result? Japan is lending its own money to itself. There is no external dependency. Therefore, there is no pressure. Rule 2, the central bank buys everything. In 2013, Prime Minister Shinzo Abe came to power. He launched the Abenomics program, 3 arrows: money printing, public spending, structural reform. The Bank of Japan, BOJ, launched the most aggressive monetary policy in history. Billions of dollars in bond purchases every month. Government bonds, corporate bonds, even stock ETF. Today, the BOJ holds over 50% of the government's debt. In other words, the Bank of Japan is the Japanese government's biggest creditor. It may sound absurd, but it's also strategic. So what exactly does this mean? The government issues bonds. The central bank buys them. The central bank prints money. The cycle continues. I can hear you asking, if this strategy works so well, why don't other countries do the same? Are there countries trying to do this? Are any successful? Unfortunately, no. Venezuela tried it. The result was hyperinflation. Zimbabwe tried it. The result was currency devaluation. But in Japan, inflation is around 2%. Why? Because demand for money is very high in Japan. People aren't spending, they're saving. Companies aren't investing, they're holding cash. The money printed isn't circulating in the system, it's sitting in bank. Rule 3, deflation culture. Japan has been battling deflation for 30 years. Prices are falling or staying flat. Wages aren't rising. Why is this a problem? Because people aren't spending, thinking it'll be cheaper tomorrow. Companies aren't investing, saying there's no demand. The economy is stagnant. But this situation ensures that debt is sustainable. If inflation were 8 to 10%, bond yields would skyrocket. Debt would become uncontrollable. But with inflation at 1 to 2%, bonds can be sold at zero interest rate. Japan implemented negative interest rates between 2016 and 2024. Yes, you heard that right. Banks paid a penalty when they deposited money with the central bank. The goal? To force banks to lend. The result? Mortgage rates at 0.5%, credit card rates at 8% instead of 15%. The government borrows at zero cost. But Japan has a major problem. Its population is aging and declining. Japan's population was 123 million in 1990. It will be 124 million in 2024. For comparison, the population of the United States was 248 million in 1990 and will be 336 million in 2024. Japan's population is expected to be 105 million in 2050 and 75 million in 2010. More importantly, the age distribution. The population over 65 is 30%. It will be 40% in 2050. The working population is steadily declining. What does this mean for the economy? Tax revenue is declining. Fewer workers means less tax revenue. Government revenue is falling. Social spending is increasing. Pension payments, healthcare costs, elderly care. The budget deficit is growing. Consumption is declining. The elderly are not spending. They are saving. Domestic demand is collapsing. Innovation is slowing down. There is no young population, no new venture. The economy is losing its dynamism. Japan is trying to solve this problem with robots, artificial intelligence, and immigration. But so far, it has not been enough. The demographic collapse makes the debt spiral even more dangerous because the economy is not growing. Without growth, debt is unsustainable. So can this system last forever? Japan has remained standing so far because 1. Foreign trade is still strong. Japan still sells a lot to the world: Toyota, Sony, Nintendo. Foreign exchange earnings are steady. 2. The world's largest creditor. Japan has $3.3 trillion in assets abroad. It is a net creditor country. In other words, it has more assets than liabilities. 3. The yen is a safe haven. Investors flee to the yen during crises. This keeps demand high. 4. Zero corruption, strong institutions. Investors trust the Japanese government. 5. Cultural discipline. Japanese people don't spend, they save. This makes the debt sustainable, but the risks are growing. What happens if inflation rises? If bond yields rise, debt servicing becomes unmanageable. What happens if the yen loses value, import prices rise, and inflation explodes? What happens if the demographic collapse accelerates, tax revenue declines, and the budget deficit becomes uncontrollable? In 2024, the BOJ began raising interest rates for the first time in 17 years. Why? Inflation hit 3%. The yen lost 30% of its value. The system has already started to crack. What can we learn from Japan's story? Lesson 1. Who the debt is owed to matters. Japan owes its debt to its own citizens. There is no external pressure. Turkey, Argentina, and Greece owe money to foreigners. When a crisis hits, interest rates skyrocket, investors flee, and eventually the system collapses. Investor takeaway. When investing in a country, look at the external debt/internal debt ratio. If external debt is high, the risk is great. Capital flight can occur in times of crisis. Lesson 2. Central bank power is not unlimited. The BOJ has been printing money for 30 years. Inflation was under control because there was no demand. But in 2024, inflation arrived. The system began to crack. Investor conclusion. Printing money works in the short term. The long-term results are uncertain. The central bank does not have unlimited power. If inflation spirals out of control, the system could collapse. Lesson 3. Demographics are a major risk. Japan's biggest problem is its aging population. If this is not solved, the system will collapse. Investor takeaway. Look at demographics for long-term investment. A young, growing population equals economic growth. An aging population equals stagnation. India and Africa offer opportunity. Japan, Italy, and South Korea are risky. Lesson 4. Sustainability may be an illusion. For 30 years, people have been saying Japan is going to collapse, but it hasn't. This creates the illusion that everything is under control. Investor takeaway. The system may remain afloat for a long time, but not forever. There is no such thing as this time is different. Risk management is essential. If you invest in Japanese bonds, have an exit strategy. It has a debt ratio of 264%, but the system remains intact. For 30 years, people have been saying it will collapse, but it hasn't. Japan will choose one of two paths: either revitalize the economy with structural reform or experience the biggest debt crisis in history. What do you think? Let's discuss in the comments.